The June quarter proved to be a particularly challenging one for investors, with short-dated US Treasury bills providing the only positive hard currency return across 16 primary asset class groups that we look at. Persistent inflationary pressures and the prospect of higher interest rates continue to weigh on the market, which is also having to come to terms with a stagflationary outlook and the withdrawal of multi-year stimulus programs. Higher interest rates impacted the valuation of long-duration growth assets, and that was reflected in the performance of the NASDAQ Composite Index, which is down 14% during the quarter in rands, and the MSCI Growth Index, which was down 12%. Traditional sort of value indices, such as the FTSE 100 and the Nikkei 225, outperformed during the quarter, while more defensive sectors such as healthcare, utilities, and consumer staples provided sector leadership. The Vunani BCI Global Macro Fund declined 3.8% during the quarter in rands, well ahead of the 7.2% decline in the MSCI World Index, and modestly below the fund's composite benchmark, which was down 3.4% during the quarter. A fairly meaningful shift in the fund's exposure was put in place during the quarter. We downweighted exposure to US equities on account of high relative valuations, and exposure to economically sensitive areas of the market such as technology, materials, and energy was switched into areas with more durable earnings such as healthcare, consumer staples. With global equities now in a valuation-driven bear market, the outlook for earnings in the second half of the year becomes particularly important. Interestingly, consensus earnings expectations for the MSCI World Index have continued to be revised higher through the first half of this year. And in the absence of meaningful negative equity revisions, we think that on balance, the outlook for equities in the second half of the year is far more positive.